Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Hello, welcome back to the Wade Borth podcast. Today, again, joining us it's been a lot of time, Nicole, but we're getting towards the end of Nelson's book. So thanks again for joining us to review Nelson Nash's book, Becoming Your Own Baker. And thanks for taking the time to go through this with me.
Thank you for having me. This has been a really good exercise.
Yeah, there's been a lot of interesting points, from your viewpoint, I'm like, I hadn't thought about that, because the more we talk about it, the more we create this community of people that want a different way to go about things, especially the financing of those things in our lives. And the more we put a community around us, the better off we're able to see through other people's lenses. I think that's really important sometimes. I didn't see it that way, but that's a great point. And again, it goes back to what Nelson talked about early on in this book, is don't have the arrivals. Go into it with a conversation with an open mind, thinking, is there a better way? Because if you think you know everything, you're basically unteachable. And if you're unteachable, then why are we here? My presumption is you're listening to a podcast because you're looking for something that's a little bit different. You're looking for something that is not the norm, and you're wanting to learn and you're wanting to engage. And you'll be amazed at how many people are out there willing to be part of your community to engage in these conversations. Sometimes we just got to bring it up. And then once you find those people, don't let it go by the wayside. Say, hey, let's find a way for you to get more educated. Listen to this podcast or whatever podcast that kind of feels that need for you, and get them educated, get them involved in that community. And that way you're going to grow your community just by bringing those people on board, having them do some education themselves, bringing them to an IBC certified advisor to help them go through the process. Because again, this is a process, it's not about a product. It's a process. First thing we do is we learn and understand what the problem is. And if you understand what the problem is, that who controls the banking function of your life, and if it's not you, that's the real problem, right?
Yep.
If you say, that's a problem and I want to do something about it, if you admit that you want to do something about it and you want to change it, then you can go forward and do that. And then we can understand the process, educate you on the process, and then find the right product that's going to fit in that process. Where everybody wants to hop to the end and thinks that the product is the solution to the whole thing. That's not the solution. It's that process of knowing. First, you have to know what the problem is, be able to filter through the rest of it, finding the process and finding the proper product. Yeah. So that leads us into one of the last chapters. It says, what if I'm uninsurable? And Nicole, you've been in the insurance business for a while. That never happens, does it? That somebody's uninsurable.
Well, fortunately, it doesn't happen, but it definitely happens from time to time.
It happens from time to time. That's exactly right. And so along with this chapter, and this is a short chapter, but like most of Nelson's chapters, they're short, but there's a lot of wisdom and understanding that's put into this. What I find, and I'm just going to give you my take on some of this, is that first off, people think I'm too old, or I'm not healthy enough, or whatever the excuse is to not move forward with a policy. And it's just that, it's just an excuse. What I'm really getting at is, don't be an underwriter. Don't be a professional actuary or underwriter. So don't assume that you're unhealthy, and don't assume that you're uninsurable. Let's find out for sure that's the case. I run into so many people like they're really hesitant because they don't want to move forward because they don't think they're insurable. And then it comes back that we can get a standard on these people. And a standard just means that you're within 80% of the majority. And people get worked up, I might have a little rating, or I didn't get preferred versus super preferred, or whatever the title they want to put on it. But if we're doing it correctly, if we're designing a policy correctly from a banking perspective, doesn't matter. Only thing that really changes is the death benefit amount. And again, the design here is to build a policy to maximize the cash. We do that typically by reducing and minimizing the death benefit amount up to the limit that the IRS allows to put in. So it plays into what we're trying to accomplish. Now, I'm not saying that life insurance or the death benefit part of it isn't important, because that is an event that happens to us all if we die, and it would be nice to have that legacy at the end. But if we're building policies correctly, and this is what I learned 15 years ago, if we're building policies correctly and we're funding in policies correctly, the death benefit grows tremendously because of the amount of paid up additions we're putting in the policy. And so you might say, I'm uninsurable, or I got rated, or whatever the situation that's holding you back from moving forward. Part of that might be, if we fund it correctly, you're going to grow a tremendous amount of death benefit in the policy. So when you graduate from this earth, there is that legacy that you can pass on to that next generation. It may not be as big as we thought we wanted, but it's better than what we have if we do nothing.
Yeah. Fear of what's going to happen if it's not as good.
Yeah, 100%. It's that thought of what if it's this. The other side of the equation is I hear a weatherman on a local radio station. He says there's a 40% chance of rain this weekend or something like that. He goes, but on the other side, there's a 60% chance that it's not going to rain. So go out and enjoy the weekend, right?
Yeah.
I'm sitting there going, that's such wisdom. Or even if he says there's a 60% chance it might rain. Well, there's 40% chance it might not. So, you might be in that area that isn't going to rain. So go enjoy the weekend. His point is go enjoy the weekend. Don't let something that might happen or might be the issue stop you from what you need to be doing or that you want to be doing. Right.
Yeah.
Because we let that fear get our way. Okay, we'll deal with it. And this is what Nelson's talking about in this chapter is that there are ways to deal with those certain situations that don't allow us to get a policy on ourselves. And all that is that we find others that we have an insurable interest on, that you're going to own the policy, you're going to pay the premiums, but I'm going to own the death benefit on you because you are financially valuable to me. And that's how insurance companies look at it. It has nothing to do with, I want to profit off your death. That has nothing to do with it. Because again, what this is a promise to pay a predetermined amount in the future. And you pay the premiums to make that happen. And the event is, for the death benefit, is that you graduate from this or you die. And it's already been predetermined what that amount's going to be. Are you profiting from the death? No, you're just putting money away. And then the insurance company is going to make sure that that money's there at the time of the death. So there's no profit in life insurance. There's just a predetermined payout at an event. And all that event happens to be is the death. Now, if the person lives a lot longer than what the insurance company thinks or the actuaries think, then you pay a little bit more in premium. But now you have more cash to you. So it's beneficial in that way as well. Or if they live shorter, then you get paid out a little quicker. But the point is, there's no profit from that. You're financially damaged if that person dies. And that's what, have an insurable interest.
Yeah. We were talking before we started recording Wisdom of Nelson Nash. And what you told me in the beginning was one of the things that Nelson is very adamant about is that you set this up as a family financing system. And so when that happens, and it doesn't happen overnight, it won't happen in the first year, but when that happens, at that point, the problem of being uninsurable has become somewhat irrelevant because now you have a family financing system. So the whole family is involved in it. And you can find somebody in the family or in your business or in your circle that you have an insurable interest in that you can now buy the policy and do the same thing. Or you buy that policy from them, or you take over the ownership from the policy. You control the policy, but it's on them.
And that's not something we advocate right out of the box, but once a policy is enforced, once it's there, it is a piece of property. It's just like any other piece of property. It's like having a piece of ground in downtown Indianapolis. Is there any restrictions from me selling my piece of property to you? Now, is it always good practice to go into a situation where, like, you have, in essence, have a straw purchase? They call that. We don't necessarily want that where you're buying it for me, but you're doing it under your name. And then as soon as it's there, we transfer it. From a life insurance standpoint, that creates some issues with the insurance companies. But if you have a policy or somebody has one, again, once you have ownership, it's just like any other piece of property. You can buy or sell, or that's how come we can borrow against our policies, because they're an asset. And banks understand this. This is the whole conversation we were having as a group yesterday, is that banks look at life insurance as not as life insurance, but as an asset on their books that has tax-free growth or tax-favored growth. It goes up on a positive basis. And the growth actually within the policy is just a bonus to them because they want a place to put their money that's safe, secure, liquid, and guaranteed. And they get that. And then on top of that, the value is going to go up each and every day. It doesn't go backwards. So they can run their banking operation off of that. So when we think about it, it's just an asset that you can do whatever you want with once you have that asset. Yeah. And this is part of the reason why insurance companies are they're very particular about how they issue a policy. They get one shot of saying, hey, Nicole, we're going to pay somebody, and we don't care who it is, because you can change your beneficiary. The day after you have the policy issued, you can change your beneficiary or ownership to anybody you want. There's nothing stopping you from that, right? But they're real particular about it because they have one chance. They have one chance today to put the insurance company in a position of they're obligated to pay out somebody $5 million or $3 million or $2 million, whatever the number is, at some time in the future. So they want to make sure that you're financially sound. They want to make sure that your health is sound. And if not, yeah, they'll still write you. They just might say, hey, actuarial tables say that the majority of the people are going to die at age 86 or whatever it might be. But because you have certain health conditions, diabetes or whatever it is, we'll still issue a policy on you. But our assumption is that we don't have as long a time to take that money and grow it for you. So therefore, we're going to reduce that obligation to pay out that benefit. And so we just reduce the death benefit. You can still put in the same premiums. It's just that you're getting less death benefit because they just don't have the time, because that's really what it's based upon. You have to understand that mutual insurance companies aren't there to make a profit for somebody else. They make a profit. They want to make sure that their money is put to work, it's safe, secure, and liquid, and the money is there when the claim comes in the door. Mm-hmm. And so all they're saying is that, hey, we're not trying to take away the cleaners, because if we profit by law, because we're a mutual company, we have to return it back to our policy. So who's to benefit? There's nobody there to benefit besides you and all the other policyholders if they do a good job. But what they can't have is say, hey, it's going to take 20 years or 50 years for us to collect these premiums over time. We're going to make a certain amount of interest rate on it. And then at that time, we can pay out this benefit to somebody that you decide is the owner, who that somebody is going to be. And so they have this time frame. We got 50 years. Oh, but I got diabetes. Okay, so let's move that back. And maybe it's only going to be 35 or 40 years that you have, because people with diabetes just die early, part of life. That's just what it is, at least today. Now, is that going to change? I think with this aging population and where all the money sits, that might actually change. And it's changed a lot since I started 35 years ago. Things that were used to be uninsurable are now being issued at standard. Things that were rated highly are now like, yeah, that's just normal, because we've, as society, we've had advances in medication and treatment. So the whole point is, don't self-diagnose and say, I'm not going to get it because I got this. How do you know? Even from an underwriting standpoint, things change on a yearly basis. I'm like, oh, I didn't know that. 5 years ago when I checked on it, that was a decline. Now we can get a policy issue. Cancer used to be one that was just automatically decline. And now it's, if you've had it for a couple of years and you have treatment and meet these certain criteria, we can get a policy at a standard rate. So don't self-diagnose. But the point is, the time frame is still a little bit different, but you can still get a policy. So that just all it says, the time frame is different. So therefore they can't grow our bucket of money as big as they need to be in order to adopt. So this would be just the amount of death benefit for the same premium.
It makes me laugh a little bit, because sometimes when you talk to people and you ask them, how are you doing? They'll be like, oh, I'm pretty healthy for my age. And then you start talking about like, oh, I think I'm going to die pretty soon. Yeah. I don't know how we went from, I'm pretty healthy to take blood pressure medicine, so I'm probably going to get declined. But
right.
Well, let's put you through underwriting and see what really happens.
On the other side, and it's so funny because somebody's, I take some blood pressure medicine and I got cholesterol, and you and half the population, you and 75% of the population are on medication. So that's a whole other discussion about the pharmaceutical industry putting people on medication. I had a client one time who says, I got thyroid issue, and the doctor says it's real serious. It is serious. And they want to put him on Synthroid, and he kind of refused to do it. And long story short, he just changed some things in his diet and his life. And man, now he doesn't have any of those issues. But we were able to get him a policy, and it wasn't that big a deal, because again, the insurance company looks at it as what's the mortality of you, not what's the morbidity of it. So right. And it looks like at somebody at your age with that condition, and they take 10,000 or 100,000 people with that same thing, and they just look at the big numbers. So they're not picking on you individually. They're saying this is what it is. So from that standpoint, again, if you think you're uninsurable, you may or may not be, but don't self-diagnose.
Yeah.
So the question is, what if the insurance company comes back and says, I'm uninsured? I'd say, okay, let's find number 2. Let's find number 3. Let's find number 4. You have parents with policy. Do you have policies on your parent? Yeah. So you have that discussion. In the previous chapter, Nelson talked about even distribution of age class, right?
Yep.
This fits right into that. If I'm uninsurable, are there other people that I can build my system around? Just like you said, you're building a system around, isn't just around one person. It isn't just around your spouse, you get your kids, grandkids, your parents, your grandparents, whatever it is that you're building the system, because it has less to do with death benefit, more to do with a place to store and hold your money. And that's where you're going to find that it really doesn't matter who it's on, because whoever it is, the only thing it's really going to change, it's going to be how much death benefit is, about how long the insurance company has to hold your money and to grow your money. And if you're growing at 4, 5, 6, 7%, they know actuarially what it's going to be. and they said, we can only promise this amount of death benefit. So it's finding that even distribution. Or go back and read that chapter if you really want to say, what if I'm uninsurable? Okay, if you're uninsurable, that stinks. That's unfortunate. But it's not the end of the process, not the end of the product. We can find something for the most. There are situations where I ran into husband and wife, had no siblings, no kids, no parents, no nothing. They're both uninsurable. And okay, so we ran into a situation where we didn't have a lot of opportunities. But what we were doing is they were just generous donors because they didn't have any kids. They were generous donors to their church. And so then the conversation is, how can I give the church own these policies on maybe the head pastor of the church because they wanted to keep him there, and they became the owners. And so it was like there was an opportunity that just was not obvious until we had a really deep conversation about what was important to you, where you're going with your money, what happens if certain things happen. And we found an avenue there. It's not maybe for everyone, but it is an opportunity that you have a great, deep conversation, an open conversation with your IVC practitioner, that maybe we can find somebody that we can find a policy.
Yeah, I think the creativity that infinite banking inspires, and that lots of different directions. And if this is something you feel really compelled to do, that you feel like the right way for you to go, you go through it with the practitioner, but you are uninsurable, just like you said, okay, so let's get a little bit creative. And I don't mean creative in trying to do things that are legal or that are just not good to do, but just like you, they took a policy out on the pastor.
Yep. Yeah. You go back to the very first chapters, and Nelson talks about this is an exercise in prophecy, right? So prophecy, that's the one that nobody ever talks about: imagination, logic, reason, and prophecy. If you know that this is for you, and if this is really where you want to go, let's start using our imagination to say, okay, how do we make that happen? And sometimes just with that thought process, if you just kind of let go and just imagine all the other possibilities, those possibilities, especially if this is what you want to do, will present themselves. But what we have to do is we have to shut down the no, I can't, and listen to how can I? And once you start doing that in your mind, then having that conversation with you or I or anybody else, practitioner, it's called creativity, but it's find different ways, but it's more like imagination. Where am I going with my money? Who's dependent? Who am I dependent on? And so on and so forth. Am I giving on a regular basis? And then how can we benefit? So approach this with, how can I be benefit? How can I serve other people or other organizations that I truly have a love and understanding?
Yeah.
And once we start doing that, then it's like, then it'll a lot of possibilities. But the point is, if you're uninsurable, not into the game. It just, that's the first check mark we have to say, okay, the insurance company told us we're uninsurable, not the internet, not, I presume that I'm uninsurable. The insurance company came back and said, hey, Bob, or whoever, you're uninsurable. We're not going to issue a policy. Then that might open up the fact that my spouse, or Bob's spouse, can now get a policy much larger because Bob is now uninsurable. So now there's a policy probably on the spouse or the kids. And so again, don't self-diagnose. Don't let become uninsurable by the internet. Talk to somebody that knows what they're doing. Look at the medical records. Let somebody that knows what they're doing, a professional, make that determination. And then once that determination is made, let's go find other options. And that's really what we're talking about. Use your imagination. Say, where else can we have policy? And then building the system. Because again, it's the system with multiple policies overlaid. Multiple policies and a lot of different people that you want to invite into your circle, as it were.
Nelson uses the story of the year old or whatever, that they have a younger daughter, and so they buy the policy on her. Just read this. I didn't really understand the logic behind that, because he talks about when the dad dies, he still leaves the daughter all this money. And if you understand how structured, and the fact that now she had, yes, if he had loan money, he's going to take the money back to pay back the loans, but of it, now it becomes her policy or mom's policy, depending on how they, that it becomes their policy to now continue and do as much as they want to with it in terms of putting money in and loaning it out and all of those things. So it's like, even though he couldn't leave a death benefit for his daughter, he did leave a death.
100% agree. That's a great observation. The reason for having policies on our kids, our grandkids, somebody else, again, I'm going to die and those policies are still going to be in place. Did I leave a bucket of money for my children or my legacy to use? Absolutely. But with that has to become the education. So this is the part that becomes tricky. So I talk about this quite a bit with my son's policy. I'm like, I want my son to have these policies, A, so he has coverage, B, not so much because everybody thinks, oh, I need to get a policy on a kid because that's where they first go. I'm like, the efficiency needs to be on you because you're much more efficient than your kid's policy. So with that being said, it's just put the policy on your children, your grandchildren, whatever it is. Not so much that it's going to be efficient for you to use the money. It's just because that's going to be their tool with their name and they're going to treat it a whole lot different, but you have to teach them as well. And so if I take a policy on my son, I'm going to use it for a lot of different things in life. So if I already used his policy, I've already loaned money against his policy, used it, put it back, paid it back, pay the premiums, continues to grow. And once he understands it, he's going to do the same thing. And then once I die, that property isn't going to change. It's not, like you said, I got a piece of rental ground and farm ground in North Dakota. And if I die, that ground doesn't disappear. That is like a piece of property. I put it on the deed that if I die, then it goes to my wife. And if we both die, then it goes to my son and then to our trust or whatever it might be. These are all things that, like I said, we can do from that standpoint if we're insurable. We're buying policies on our kids. And then when we die, now they have the bucket of money there, or they have a bucket of money there with some loans on it. Big deal. They're still there. Nothing changes. And now they have the ability to say, hey, I understand that I have $20,000. I'm going to put that money I'm going to pay off this loan so that I have ability to borrow $20,000 the next day, 5-10 days later, whatever. So
yeah, it just dawned on me as you were saying that in this example that he gives of this dad that buys the policy on his daughter. So let's just say the policy goes to the daughter at dad's death and he did have a loan on it. So I don't know, let's just say $20,000 loan on it. She can start putting money into that policy and every single dollar that she pays back to that loan is now her money to use. So
and Nelson talked about that, right? He talked about windfalls, right? You got to have places when I die, my son's going to have windfalls, right? From death benefits. He needs places, he needs holes to put that money in. So if it's a policy loan that I have a policy loan in his policy that I use for whatever, but he can now take part of that windfall and pay off that policy because every dollar he pays back to that, he can turn around the next day and borrow that back from the policy. It's not like it's lost or gone or in somebody else's bank. It's not like a car loan that you pay off and you don't have access to it. The money is back in your policy. It never left your policy. The lien is removed from your policy. And so now you go lien against it again and take a loan. But Nelson talked about that. I mean, when he died, he left a lot of people with windfalls. And I did a podcast with David Stern. And that was part of the conversation we had at the think tank is that when he goes into Nelson and Nelson said, hey, you got a policy loan, getting policy loans. And David, sheepishly said, yeah, I got a policy loan that I haven't paid back in 3 or 4 years. I wasn't being a good banker. I wasn't being a banks. And Nelson was like, good, because when I die, and give this Nelson has death benefit. So when I die, you're going to get death benefit. You have to go somewhere. Now you get a place to put that. And that's how he believed the system works. And if you think about it from that standpoint, it's just, again, it's a piece of property that has a lien against it. Just pay off that lien. And then you're guaranteed to be able to use it again in the future for whatever purpose you want.
Yeah. Isn't that interesting that you have a person that's so immersed in infinite banking and the human condition? So the desire to go not pay the policy, like that still has to be something. We talked about that too, that you have to really have discipline and control. It doesn't matter who you are, how much experience you have, how old you are. It is a constant thought process of I'm disciplined.
100%. Nelson talked about Parkinson's law. You have to fight. If you don't remember Parkinson's law, go back and listen to that chapter about Parkinson's law. But he always said, you have to fight it every day because it will creep in on. You will spend more than what you make. You will not be an honest banker. You'll steal the peas just because that's human nature that we live with. So you just have to fight it and be disciplined and fight it every day. He never said that it's going to go away. Quite frankly, he said the opposite, is that it's always going to be around. You just have to be cognizant of it and just fight it. And he said, if you can do that, you're going to win by default.
Yeah.
If you remember that conversation.
Yep. Win by default is a really good way to put it.
Yep. You win by default just because you're beating Park.
Yeah.
You're not being in the average everyday United States consumer. You're not a consumer mindset, you're a business.
Yeah.
Anything else to take from this chapter? I think there's some illustrations that he goes through. And I think the illustrations are helpful in the book when you read the book. I try not to get too bogged down in the illustrations, just because, again, he puts those in there just to drive home a point, not to say this is the only way to design it, because, again, this book was written over 20 years ago. So some people get lost in the numbers. And I'm like, never about the numbers.
Yeah.
It's about the process of controlling the banking function in your life.
Yeah. And I will tell you that when I first read this book, even though I'm in this industry and I understand how to read illustrations and I can make sense of this stuff, the illustrations like those I just skipped right past most of them. I looked at them and skipped. So for the average person that's out there going, I can't make heads or tails of this illustration, you don't really need to understand the words, understand what he's written. If you're curious, if you feel compelled to learn more, we'll help you with that sort of stuff. You don't need to worry about spending hours on these illustrations.
100% agree. Exactly right. If we do it right, if we're having the right conversation, it's not about the numbers. It's about the process and how we take it over. And then the numbers are important. Eventually we have to say, yeah, the numbers make sense. But again, if what we're doing comes from the position of control and freedom, then the numbers aren't. It's so easy. It's intellectually lazy to say, what's the rate of return? Like, who cares what the rate of return is? It's like, when I have access to my money and freedom to do what I want to, do I care what the rate of return is? I ask the question all the time. Do you think Wells Fargo, again, with $20 billion of properly structured life insurance in their asset portfolio? Let me say that again. Bank of America has $25 billion last I checked. Wells Fargo has about $20 billion in properly structured life. Do you think they get wrapped up in the rate of return of the policy?
No.
I think they concern if it's 3.5 or is it 4 or is it 3? They don't give a hoot about the rate of return of the policy. Why do they put money there? Because where they make their real money is by lending it to people that don't understand how banks work. That's the whole key. That's how they make their money. And they make 3, 4, 5, 800% rates of return versus us squabbling over a fractional rate of return. And that's what they want us to focus on. And that's what they want us to look at. But it goes back to previous conversations in one of the previous chapters. They want us to focus on the toaster they're giving us to open up an account in the bank. And they want us to ignore the process of banking, how banks really make money.
Yeah.
So it's that I'm going to pickpocket you. So I'm going to get your attention over here. I'm going to pull your wallet out the other side. That's what they want us to do. And that's where everybody gets locked in this idea of rate of return. And that's where I think I see a lot of people go to the numbers and the illustrations in the book. And actually, Nelson, I think after he wrote the book, and we had a lot of conversations, I wish I would have left those out because people get distracted by the wrong. They don't understand the process. They want to look at the numbers. Got to make sense. When you have access to cash, good deals are going to find.
Yeah.
And I'd use the example. I bought a piece of real estate right in your backyard, Nicole. Mall we have in Fargo, North Dakota. I bought a piece of real estate down in Indianapolis because the guy had to move the property. And I had access to the whole price of the property in my policy. And I said, he wanted $140,000 for it. I offered him 110. We sold at 114. We closed in 5 days. And now that property is worth over $250,000. What's my rate of return? Are people going to get into? I know that's not really this chapter, but it just, for whatever reason, it's speaking me to talk about. Don't get wrapped up in the rate of return, because my rate of return on the external side, the external rate of return was huge. Right? I had access to cash. And I was able to, because I had access to cash and I didn't get anybody else's approval, I saved myself basically about $30,000 on a $100,000 purchase, $130,000 purchase. Was that 30% rate of return instantly? And I was able to close that deal immediately instead of having somebody else kind of swoop in and grab it for me. And now it's worth $250. What is the rate of return?
Yeah.
It has nothing to do with policy. Again, that's how banks see is they need a safe, secure bucket of money so they can go do what they do the best, which is bank. And that's what we're trying to teach people. That's probably a good way.
I'm just thinking what you just said about buying this property. And so you took a loan for your policy. And so your policy is still growing, even though you have now it's ready and you've invested it in something else. So growing. And that is the cool thing about infinite banking. And until you can look at that and go, wow, that thing I would want to do.
Right.
That it just stays as a concept out there. This is what turned me on so much about infinite banking. It was just like, there's so many opportunities out here.
Yeah, the possibilities are infinite, right? That's why Nelson calls it the infinite banking concept, right? It's like, It's not about the rate. It's about things we can do if we can just open our imagination up. When we have money available to use, we can open our imagination up, find out what our passion is, and say, how can I make an asset work for me? So I don't have to work for my money the rest of my life. How can I make my assets work for me? And what's that passion? What do I find desire to do? And once you find that, there we are. And then all it needs is money to make it happen. Oh, we just happen to have this bucket of money ready to put to work, right? We're going to deploy our capital. And now we have passive income coming to us because whatever we did, our policy continues to grow. And it's just understanding the banking process. But everybody wants to get wrapped up in rich return because those are your 401k investors, because that's all they have to work with is rate of return when you put money in a 401k. Not that putting money in a 401k is bad. Not what I would do, because I want control of my money so I can put it to work to what drives my passion, not putting money in and letting somebody else control it and the government tell me when I can take it out. All those strings attached. That's not my desire. So I just don't.
Yeah.
But it's finding that desire and then finding what your passion is and say, that's what I want. I want to own real estate. I want to own vending machines. I want to own cash machine. Whatever it is, there's a million things, infinite amount of things you can do to grow passive capital. You just have to have capital to make it happen. And if you understand and think like a banker, you're building a bucket of capital to make that happen. And then when you do use it, you have to make sure you pay it back because it's going to be the next opportunity, the next opportunity. But if you're not honest and you're not putting inventory back on the shelves, like Nelson talks about in the grocery store, then those other opportunities aren't going to be taken advantage.
Yeah. And once you get into this and you're like I have been looking at this going, dang it, I wish I had done this earlier. Then it's, let's just get more money in there because I know these opportunities are not going to go away. They're going to continue to come. And I want to be prepared to take advantage of them when they do.
Exactly. That is a perfect wrap up for the Nelson's book. Have money available to take advantage of opportunities when they come your way. That's what Nelson talked about many times. And then using imagination, how you make that happen.
Well, Wade, this has been really good. My mind is constantly thinking about this and how to help people understand it and how to use the policy and how to grow my own policies. And every time I read this book or go through one of these chapters, I have new experiences to plug into the words that I'm reading. And I appreciate you giving me the opportunity to do this. This was good.
Yeah, it was perfect timing. It just, you knew it, but you still remember what it was like when you first read the book. So the further that gets away, we have a tendency to forget so I appreciate you taking the time and giving a perspective to what it was like when you first read the book. I remember when I first read the book, but some of the thoughts, some of the emotions I had with it, it's been 15 years. So it tempered a little bit. You just don't remember it well. So I'm glad you bring that perspective back to this conversation.
Yeah. It's been fun.
It's been fun. Yes, it has. Enjoying this podcast or know that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, because we can be easily found on Apple Podcasts and Spotify.